Thank you for sparing your time over weekend and joining us. I am Nisha Gopal, co-founder Taxpoint Pro. As you all know that we are into providing the goal planning services, investment advisory and wealth management services as one of our vertical, and it is always our endeavor to provide the best investment opportunities for our clients. So today we have arranged this webinar for you where we will be discussing on the opportunities in the current market scenario. I am glad to share that for this discussion we have Mr. Ashish Chok with us. Mr. Chok is the head of institutions and products at Purnatha. He is having a vast experience in wealth management and have worked with prominent players like Kotak Securities and JM Financials. Mr. Chok holds a master degree in business administration. Thank you, Mr. Chok, for accepting our request at such a short notice, and a very warm welcome to you at our platform. It is our pleasure to have you today.
Thank you, Mr. Agarwal. That was quite an introduction. Thank you. So, good evening, everyone. I get to know that we have another clients in on our platform today. So, in India, this is evening. I think we just started at 8. Okay, so I'll cover a few points. So, first thing is the talk of the town these days has been the rising inflation. Okay, so beside rising inflation, the second thing which everybody is talking about, the cost of borrowing or the Fed rate or interest rate, what you can call it, either of it. So that's the other thing which has been on the talk. So how it's going to impact the investment side, how our style of investing, which is known as growth style of investing, uh, and I'll brief after that. I'll brief about what is the minimum ticket size for PMS and what is the differentiation between PMS and mutual fund. So, if you permit me, I'd like to share few slides with you all, okay, to make you understand as to what exactly is happening and why exactly these things are happening. So there are few terms which we have been reading very often now. So one of the term which is quite visible, I think every month is US inflation has been at a 40-year high. Okay, point number one. So the term, other terms which we are not used to is inflation in Europe. So if you look at what happened in Europe since the last quarter, so last month has been a very scary month for Europe. So one of the things which you are reading these days is European bonds, point number one. So 10-year bond yield, what I'm talking over here. The other thing is inflation. So Germany crossed two digits. So they are 10% plus on the inflation side for month of September. Okay, these are few things which are going around, and of suddenly out of the box, there is one thing which has happened in UK, so United Kingdoms, where we have seen uh, the central bank over there have announced a QE, that is quantitative easing. They have started printing some money over there. So it's a contrary thing where one side you are trying to fight inflation, the other side you are trying to pump in more money. Okay, so they have their own reasons to do it. So we were also looking at whether this move will let others print money. Okay, this could have created a different situation altogether, but it didn't happen. But yes, the talk of the town these days is more on the rising interest rates. So let me be very clear on one thing. So this rise in the interest rate, what we have seen. So let me put it the other way. So Fed has actually hit a hat trick of increasing rate by 0.7 percent, so 75 basis points. So they have done it consecutive times now. So this is the fastest pace at which they have increased the rate. So if I talk about what was Fed was at 0 to 0.25 in the month of March. So from April till October, what we have seen is the rates have already touched 3.5, and further it is about to touch around 4.4 to 4.5. That is what Fed has said by the end of the year. So this is what it is. So, but from where it started and why it started is important, and why it's happening. So one thing is very clear that we have been hearing that from Europe specifically, we have been hearing a few things. That is, uh, the inflation is because of Mr. Putin. So that's exactly not the thing. Yes, Europe is has a problem of supply side, that is natural gas which they take from Russia, and US doesn't have this problem. So US inflation is not a problem which was created because of the war or the geopolitical situation. So they were close to 8% before the war started. So that's the fact. So I'll show you a few of the data if you allow me to do that. I have the rights to? Yes, I do have. So is it visible?
Yeah, it is.
Yeah. These are US inflation numbers. So why I'm trying to show US inflation numbers, because the US is actually leading the inflation side at this period of time, and the problem started after they touched a high of 8 point above 8%. Okay, so this is what the numbers are. So current numbers are already there, so which we saw coming 2 days back. So US is at 8.2 currently. So September numbers are 8.2. So if you look at these numbers, so US was on an alarm bell since May 2021. So why I said it's on the alarm is because above 5 for consecutively 4 or 5 months, US has never been above 5 for quite some time. So when I say quite some time, it's been more than 40 years they have not been above 5%. So even in 2008, what you look over here is, so these are the months, so June, July, August, were 3 months only where the inflation was above 5. So consecutively above 5, they have not been there for a quite some time now. Okay. So what the worry was when they crossed 5 in May 2001. So other worry which happened or markets got a tick was in December 2021, where US numbers, inflation numbers touched 7. So these numbers are above 7 since then. So this was the point where US 10-year bond yield touched 2%, and this was the month, or I'll say ki at the end of 2021 calendar year, this was a time where US started correcting. So we saw a good amount of selling in the month of December 2021. So to the tune of above 1.5 trillion was sold by hedge funds and by few pension funds that time. So that was the first exit which we saw, and this happened because of the bond yield which touched 2. So US dollar is, or you can say, that's one of the most safest instrument which is to be believed today. So the money generally moves to that direction if the bond yield goes up. So currently what we have seen is 10-year bond yield on Friday. Yesterday I was already touched a 52 weeks high, and it's closed above 4. So this has happened. This is a serious thing which has happened after a long period of time. So other thing is US 2-year bond yield. Generally, the difference what we see is very less, but this time the difference is for almost around 30 to 40 basis points. So it is close to 4.4, and this is happening because the Fed is confident enough to increase rate before this end of this calendar year. So that's one of the reasons. So if you look at this data, what we are seeing over here is, so US has been above 5% for consecutive now 16 months. So at the start of the year, Fed was expecting inflation numbers to come down to 5.6, which doesn't look like at this period of time. So US Fed will be more harsh on increasing rates in coming quarters. And till the time they don't see inflation numbers coming down, and it was expected that September month typically would be a month where they could see some cool off, which didn't happen. One of the reasons of the cool off, I'll discuss that later. So this is one part of it. The other part of it, when was the last time you saw these numbers? So if I go back and look at these numbers, so in the year 1980-81, so this is the time where the last time where we saw US numbers above 8. Okay, so the highest what we saw on a monthly basis was in the month of June 1980. So it's good that we have not crossed 41 year high. So that's, if you see a 41-year record being broken, that means you have already seen that US inflation is touching more than 4.7, 4.8. So that's a worrisome thing which we might not see. Okay, because Fed has already started taking action. So what happened this period of time is important rather than just going back and looking at numbers. So this was an era where we saw Fed chairman during that time increased rate by almost 8% in that year. So taking the Fed rate to close to 20%. So this, if you look at that, after that when it was increased in 1981, we saw that inflation numbers started coming down, but it took a lot to cool down. So it took the entire 1980 to 1 year to cool that number down, and it went down to a below 2%, what is their target in the year 1986. So inflation coming down is some one thing which takes a little longer period of time. It's a prolonged period of time, and interest rates are one thing which are increased, or that this northwards movement which we are looking at is happening little fast. So this curve has to be flattened. So when I say the curve has to be flattened, currently the curve is moving towards north very fast. The curve has to flatten. So when it flattens, that is a sign where you'll see inflation numbers coming down. What I mean to say is, Fed will stop increasing rate and will have a look that it is not required to further take out money from the system. So that's one sign where you can look at in the coming, at least after 4 to 5 quarters, where Fed might start flattening interest rates or might not increase rates the way they are increasing now at this period of time. So this is one portion of it, how we look at inflation. So generally, we divide US inflation into three parts. The one is your core inflation. The other is what we very closely look at is US inflation, that is on the food side, food inflation. So if you look at US food inflation is one of the real worry sign, because it's trading above 10%. And this is the consecutive fifth month where we are seeing that US inflation numbers have been above 10%. So this is one portion of it. The other what we look at is energy inflation. So if you look closely at US energy inflation, so energy inflation peaked at some time in the month of July at 41. So currently it has come close to 20%. So that's another worry for US. And we have been talking about that winters are coming. We are in winters. So winters generally are the time where you will see crude or gasoline prices are generally, how your inventories are there for winter. Point number one. Point number two is OPEC will have to take a stand of not cutting the production, which they have already taken a stand of cutting production. So if they keep doing that further after another month or two, you will see the pressure on the prices of both gasoline and crude will be there, and the prices are going to stay above. And we have already seen from $83 bottom, we have seen that intraday it was much lower than that. From there, it has come back to around $90. So that's another worrisome thing, which might we might see pressures on the pricing. So when I say upward direction, so that's one thing which is worry at this period of time. So this is about US inflation. So what we have seen in the past is whenever US Fed has increased rates, at a steep rate, or they have moved rates very fast. So we have seen these, when you see these gray areas, these are the areas where we have seen US has gone into recession. So after every steep hike, we have seen that there is a follow-up of recession which is there. So this is the area where 2008 happened. So people have been talking about, is this an era of 2008? So it doesn't look like it's an era of 2008, because these are two different situations. That period of time we had subprime, and there were multiple financial institutions who were overly leveraged. Rather, the entire financial system was leveraged on property. So that led to a major fall, and the gap of around 1.5, 1.6 trillion happened that period of time. So currently, we are not looking at a 2008 situation. I'll come to as to how we are different that time and now. So rather, we are, if you believe that we could be in this era or in this era, okay, so we are still not come to this portion of it. So other thing, what we closely watch are on a monthly basis. We watch few of the commodity, or you can say the prices of commodity, which determines inflation. Okay. So what we have seen is September was a month where we saw commodity prices, especially on the energy side, cooling off anything between 7% to 25-26%. So this natural gas cooling off was a relief. So this happened because of two reasons. One was Russia was not supplying much because of the maintenance. Point number one. Point number two, they have stopped supply from Node 1 to few areas. So the Node 1 is not exactly functioning the way it was functioning earlier. So the supply has been really low, because of which we have seen some correction on natural gas. So other thing what we look at is metal. So metal has been from flattish to a little negative. It has not been going down that fast, where energy prices have been going down. So other thing is agri. So that's one good sign where we have seen agri has been correcting. Except for few of the commodities, I've picked up only the important commodity at this period of time. So palm oil is one thing which is being exported by Indonesia, where we have seen it has come down on year YOY basis. So this is year on year basis. But there are few commodities which have still not come down on a year basis. So wheat and rice are two other commodities which are still up on a year basis. So if we break, other thing what we spoke about was inflation in Europe. So Europe inflation, difference between Europe inflation and US inflation is Europe is more of a supply side inflation, and US inflation is more of a demand side plus a supply side. Okay, so that's the real difference. So when I say supply side is when your demand is constant and your supply goes down. Okay. So US, what we have seen is the demand has not been rising that fast across, but supply has been impacted. So if you look at this chart, so energy contributes around 51% of their total inflation. So that's how expensive thing has been for them on the energy side specifically. And the other thing which has impacted them is the drought which they saw this summer. So that has impacted them in a bigger way on the side where there has been some water problems. So there are factories which have shut down. So in few of the industries which led to shutdown was on the aluminium side, zinc side, auto ancillary, so paper. So these are the industries which require a lot of water and energy both. Okay? So they have been forced to shut down. Not fully, but partially it has been shut down. We have seen that impact, positive impact happening in India. Okay, that I'll cover on the later stage at the end of the session. So that's how we look at Europe inflation. So I briefly told you about the difference between US inflation and the European inflation. So when your demand doesn't go up and you try to solve a problem of the supply side, you try to match your supply side with the demand. So the problem over with Europe is when the demand is flattened and you make sure that you reduce the demand, you'll have to put double the effort to make sure now the demand goes up. But with Europe, the problem is they have a aging population. That means the consumption will have to be created. So consumption can only be created if you have a positive birth rate or the fastest birth rate, which we don't see in Europe. The other way around is what US does is you call a lot of immigrants or you invite people. So humans are the real resource for them. So that's one thing which we believe that we might see immigration. There is more immigration happening in Europe and Canada both. So that's the other way around to increase the demand on the other side. So this is on the inflation side. What I have told. So vis-a-vis what's happening in the world, there is something which is keeping India away from what's happening in the world. So what's making India, if I look at the global markets, they have corrected anything between 15% to 24%, or to be precise, the last week there have been 30% downside in few of the indices of the developed economies. So what's keeping them down, and India has not corrected in the similar way. So point number one, what has happened is we have seen FI selling getting reduced. So we saw that in the month of August they have been, in the month of September they have been net buyers. In the August they have been net buyers. September they have again become a net seller. So October is a month where they have again started uh, being on the negative side. But whether this negative or the sell off, which was there earlier, it's in the similar fashion, no. So the sell off is now lower than what it was earlier. So what we were looking at earlier numbers were way higher than what we are looking now. So that's one of the reasons. The other reasons is there has been a lot of participation by domestic investors and through mutual fund route. So that's the other sign. Third is whether we see India compared to the world where they are facing a problem of inflation. So India is quite well placed compared to the world at this period of time in terms of inflation. So we, although the numbers for last month have come above 7, but still we are at far lower level than what developed nations are at this period of time. So the problem with the developed nation is if you don't have demand and if you have higher prices can lead to a further problem. With India, demand is there and it is quite visible with two, three aspects what we look at. So point number one, what we are looking at is here is you can look at GST numbers, which have been constant above 1 lakh 40 crores for 7 consecutive months. So this is a positive sign, and what we have seen as is government has been proactive. So what we saw in August that there have been few uh, commodities or few items which have been included in the month of August to make sure that GST numbers are higher. Okay, so point number one. Point number two, whether we see these numbers going up at this rate, we see this curve to be flattening for some time now for this present. So the good part is that we are already in a festival season. So we have seen August, July numbers being higher, August being constant, and September being higher. So August is generally a month where you see the numbers they go down because that's a month where you see winters. But we saw these numbers being above 1 lakh 40, so that's a good sign. So these numbers are going to be plus minus 10% for the next part of the year. That is what we are expecting in this period of time. So that's a good sign ki your GST numbers are going good. The other thing what we notice is UPI. So UPI has been touching a record high in terms of number of transaction. Point number one. Point number two, in terms of value. So last month also they have clocked above 10 lakh crore in terms of value. That's a very good sign. What we are seeing at the bottom of the curve also the spending is there. So it's just not on the higher curve, it's on the bottom also the of the curve the spending is there. So on the consumption side, India doesn't look to be worried at this period of time. Point number one. Point number two. Point number three is what we are looking at is PMI. So if you look at across the world, PMI has been going down towards south. India, the trend has been still positive. Okay, and we continue to see this positivity for quite some time. Yes, we might get impact get impacted by if there is a recession in US or Europe, but that impact is not going to be there for a very long period of time because of two reasons: because of the consumption in India, point number one. Point number two, world is looking for an alternative for supply, so India is standing as an alternative over there. And third is your PLI schemes, which has been approved or being announced by the government. So this is what we look at India separate to the world at this period of time. Yes, balance of trade is one problem which we look at, which India is facing now. So because of two reasons. One is you've already seen rupee depreciating against dollar. Point number one. Point number two is crude is still above the comfort level what India wants. So we of our total balance of trade, crude is still contributing close to 50%. So that's a worrisome thing what we have. So if you look at China balance of trade, which saw a new high in the month of July 2022, $201 billion, vis-a-vis we were minus 30. So now this curve has started again reducing. So what I mean to say is from 30 it is going down to 27 to further down. So that's a good sign signal what we are looking at. Okay, this is primarily what we have seen is PMI numbers on the manufacturing side has been good. Even on the service side, what we are seeing is the numbers have been good. Plus monsoon has been good this year. So that's another positive for India. So we have already at the end of the monsoon. So this is a return monsoon which has crossed above 80 in the first 10 days itself. So that if the range continues in few pockets, you can see inflation going up because of that. So that's for the short term. That is one thing which is worried. So even RBI has come and spoken the same when they increased the rate by 50 basis point. They said we are looking at inflation very closely, and the inflation is not at the comfort level what they are looking at. So interest rates can further go up in the coming quarters. That is what RBI has told. But we are in a far better situation in terms of inflation compared to the Western world. So if international commodity prices they come down, so you'll see inflation impact happening in India in the similar way. So this is what on the global market at this period of time. Okay, so there's something which before I go to our philosophy and I discuss few things, I'll just try to relate what is the difference between 2008 and the current 2022. Okay, so any questions till now on this, or should I continue and then we can take the question part?
Yeah, Mr. Chuk, we don't have any question as of now. You may please continue.
Yeah. So So the two things which is worrying the world is your cost of borrowing. Okay, when your cost of borrowing goes up, it directly impacts the profitability. So if your cost of borrowing goes up and you've already done capex, so impact doesn't impact just impacts your profitability. It impacts your working capital also uh, and your source of capital. The other thing is when your commodity prices are higher, so you get cornered by both the ends. So first is the cost of borrowing which has gone up. That hurts you. The other thing when the commodity prices are going up and suddenly starts falling. For example, you a company in a cyclical business, what we have seen is metal companies have corrected good in the last 2 months or so. So the reason is what we have seen is cost of borrowing going up. The other thing, commodity prices going down. So what happens is your margins reduces. Point number one, and point number two, your cost of borrowing goes up. So it reduces the margin on both the ends. So you're not able to either command the price. Okay, point that is the there, and because of higher interest cost, you're not able to maintain the margin too. So this is a typical problem when it what happens with the cyclical companies. So if you enter the cycle at the right time, you benefit a lot. But when you don't enter the cycle at the right time, that's the major problem you face. And at this time, cost of borrowing is going to impact companies in a bigger way, because interest cost is rising way faster what we have seen in the past. So other thing is the companies which are debt free, okay, so will have an advantage, added advantage. So why I'm talking about debt free companies is, when your cost of borrowing impacts your profitability, would you like to invest into companies which have got higher debt, knowing that these levels are going to be higher for quite some time now, which you have already seen inflation once above 5% in developed economies takes good 6 to 10 years time to come back to the same level of below 2. And we have seen interest rates doesn't cool off that easily, and this time you, governments are not coming and helping you out by printing money, because they are forced to withdraw money. So what led them forced to withdraw money is another thing. What we saw in US, I'll just take an example of US, is in 2020, when COVID came, so there was a panic across globe. So to resolve that panic or social unrest, what Fed or US Fed did was they started printing money. But you can't print money to any extent. So they've never printed that much amount of money which they printed in just 2 years. They printed close to $9 trillion, above $9 trillion, which they've stopped now. So that created major problem, and that led to a higher inflation. So what we are seeing now is a problem of a higher liquidity. So the first thing which needs to control is liquidity, for which Fed is in a mood to increase rates. So this liquidity will keep coming down as and when Fed increases the rate. So what makes us different than others is, we don't invest into companies which have got debt. So first thing is, what are our don'ts? So we'll not invest into companies which have got debt, or it has to be net cash company. Point number one. We'll not invest into any of the PSUs. Third, we'll not invest into cyclical businesses, because it is very difficult to actually predict cycles, and we don't want to get into a phase where cycles go against you with a small overnight event. So we don't want to get into that. We don't invest into companies which are promoted by individuals and they have multiple businesses. So we want promoters to have focus on one business which is their bread and butter, or it has to be a professionally run management. So that's what we look at. So the idea behind investing into debt free companies was, when you pick up companies, and what is the risk involved in picking up companies. So when we did our back testing, we saw 80% of the reasons for companies going bankrupt was they had debt, and they were not able to gauge these financial cycles where interest rate goes up and your demand goes down. So the second thing what we look at is the companies which have got history of at least 8 to 11 years. The reason behind 8 to 11 years is, we look at companies who have gone through two political and two economic cycles. The reason behind going two political and two economic cycle is, what current situation or economic cycle we are looking at is, where the cost of borrowing was lower a year back, and suddenly the cost of borrowing has gone up. So how companies will scale through these times? So we generally tend to pick up companies who have gone through these times and they know how to play around in these times and become net cash. Third is, we look at companies with the volume growth. So 10% volume growth, generally what we used to look at earlier, so which now we are coming to between 6% to 10% volume growth. So the reason behind volume growth first before sales is, it's like, if how what is a unit that you have sold. Example, a company has sold 100 units this year, and next year whether it's able to sell 110 or not. The reason behind volume growth is, because you have two things which is coming. One is your existing customer which is coming, the second is new customer. So the brand connect is there or not is important, and whether the company is able to get new customers or not. So that's the third part of it. And the fourth is, what we look at is operating cash flows. So we look at a 20% plus operating cash flows, which is very important. Why we look at operating cash flows? Because we want companies to do capex from internal accrual itself. The reason is, if you want to do capex, looking at the growth, because for us volume growth is very important. That means a company has to do a capex every 2 3 years. The reason, it helps the company to foresee demand, plus it helps the company to diversify on the product and do a proper product mix. So that's very important. Other thing is, on the debt side, we'll not invest into that. I've already said. But on the financials, that is financials. You can't avoid debt. So that's one portion where we look at debt, because that's the core asset for them. So NBFC and banks are the other sector what we look at. And when we do the entire process, what we get out of this entire process, so my universe comes down to only 45 to 52 companies. So the reason behind 45 to 52 companies is because I don't want to have any of the Satyam or Yes Bank in my portfolio. So my checkpoints make sure that I don't get companies like Yes Bank or Satyam. So you will not have companies which have got these problems, because there are a lot of checks before my universe gets into. Uh, so of the universe, we invest into around 12 to 14 companies. So that's our focused portfolio. The other portfolio what we run is a concentrated portfolio. So in a concentrated portfolio, we have 6 to 8 companies. So that's the difference between concentration and focused. So what I've told, I just go through. So this is net cash business. What I look at: superior volume growth, constant revenue growth, and operating cash flows. So for this is on the financial side. On the management side, what is important for us is high skin in the game. So we look at promoters who hold higher stake, just not this, but who are involved in that business, and that business is his pure bread and butter. So we want promoters to be involved and his wealth to be created from that business. Strong leadership track record. So professionally run businesses is what we look at. So that's the other thing, and efficient capital allocation. So efficient capital allocation is capex. What we closely look at. So promoter will also have to get in capital, and from internal accrual, that is what we look at. So this is our investment philosophy, and how we are different. So this style of investing is known as growth style of investing. So if you look at current cycle, it's whether it's going to impact us, whether my cost of borrowing is going to go up. So companies where we have invested, so they will not have this problem. Rather, so there is a time where you will see our companies, they have a added advantage, because it leads to a margin expansion also. And the other thing is, when a company is looking at organic growth, it helps you to do an inorganic growth in tough times, where there are a lot of competitors who are not able to manage debt. So you do an inorganic growth by acquisition. So that's the added advantage we get. So we'll not see pressure of margin pressures for companies where we have invested. There could be 1 or 2 quarters where you can see pressures because of the commodity prices, but on the demand side, it doesn't come that often. So this is our investment philosophy, and for when we do this, after that, what we get is 45 to 52 stocks now. So earlier, because we were looking at 10% volume growth, we had a lower universe. Now the universe is expanding. So that's how we invest into operating history, volume growth, revenue growth, and operating cash flows. So this is on the investment side what we look at. Okay. On the portfolio management services, that is what I've told you, that we have a focused equity which has got 12 to 14 stocks. So a PMS typically uh, will we have a PMS which is known as a concentrated PMS. So how we are different from mutual fund? Point number one is, in mutual fund you will generally see that after a certain period of time there is a profit booking in a stock. So what we do, or our approach of investing is, we don't rebalance our portfolio. That means for us, if we have bought a stock, it is a buy, and when we want to sell, it's going to be a complete sell. It's not going to be a rebalancing. That means if I've invested into Bajaj Finance and Bajaj Finance has become a 30x for me. I'll keep investing. Weightages are going to change, but I'm only going to sell when the numbers are not there. When I don't see any of my parameters on a regular 2 to 3 quarters, that is a point we take a call to exit. So for me, it is not a rebalancing. I'm not going to trim down or book profit for my clients on that. It is just a sell for me. So that is one big differentiation what you look at with us, because we are one of the fund managers who invested in Bajaj Finance in the year 2014. We are still holding on to Bajaj Finance till now. Rather, the one of the other stocks which we invested after listing was DMart, Avenue Supermart. People have been telling that it is an expensive stock, or after the listing it has been told that it's an expensive stock. So we don't look at price to earning. So what we look at is volume growth and OCF. So that's one of the major reasons you'll find in our style stocks are little expensive on a price to earning basis, but not on their earnings, that is on OCF and on profitability. So what we look at is how much operating cash flows the company is going to generate in the coming years. So that's the differentiation we have with others. So max allocation in a particular stock is going to be 10% in a single stock. So that's the cap what we have kept in focused equity. In concentration, it is 17.5% for maximum, which will reach even one stock. So only two stocks can have that. And the other thing is we don't invest into small cap at this period of time, because we generally look at our history, and where there is volume, that is where we look at. So other thing, what you see over here is how our distribution is there. So currently we have close to 20, because we have sold in last month we have just sold one of the stock. We have booked profit in Tata Consumer, which we entered at around 300-350 levels, which we booked at 800 plus. So that's where cash generation has gone up a little. So the other thing is on the large cap we are close to 70%, and mid cap we are close to 14%. Rest is all on cash. So these are the sectors where we invest in. So the idea of picking up a stock is that it's going to be diversified. Point number one. Point number two, there's not one sector focus what we have. It's a multi-sector focus. Whether it's financial, material, retail, IT, healthcare, we are in 7 to 8 sectors currently. Minimum ticket size for PMS is 50 lakhs, and that's the difference what you have from mutual fund to PMS. And one thing which is there for us is that you can go for a STP option. That means your money can get deployed in 10 lakh equal in the next 5 months. So that's a option which is there to invest for our investors. So that's from my side. If there is anything else which you all want me to take on the question, Mr. Agarwal, you want me to say anything? I'm happy to explain. These are our plans, which is there is a management fees of 2.5% and 1.5%, with a hurdle rate of 25% and performance fees of 20. The second option, 1.5% hurdle of 10 and performance fees of 20.
Thank you, Mr. Took. It was really an insightful session where we all got to know about our India's position in the current scenario, and like what is PMS and what it is all about. Now, I think we have few questions in our chat box which I can read, and if you can address those query. Our first question is, what is the return range we can expect in PMS? I am in already IMF investor in investing for the last 5 years, and I am getting a return in the range of 12 to 15%.
Sir, this portfolio for a first client, so we were earlier advisors, and from there in the year 2020 we moved to PMS and AIF market too. So our first client portfolio since 2014 has a CAGR of 30% plus in the concentration side, but you can expect above 5 to 8% above Nifty returns. That is what our focus is, because what we look at is quality stocks, and these are not cyclical stocks in any nature. These are all growth stocks. So growth style of investing is one style which stays there for a longer period of time. So on a shorter curve, we don't look at our performance. We only look at performance at a longer curve.
Okay, thank you. Next question is, will rupee depreciation have positive or negative impact in Indian economy in the upcoming US recession?
So the first thing what I said was the difference between Europe and US is clear differentiation about demand and supply. Okay, so Europe is more of a supply side, and US is more of demand plus a supply. Okay, so a major contribution to US inflation is labor wage rate, which has gone up substantially. Okay, so we don't see any of the tick at this period of time, which is showing us that US is going to go into inflation. So it's more of a media hype than actual numbers. So if you look at numbers, rather you are already at a plus pre-COVID level where unemployment rate is way lower. So your unemployment numbers are coming really bad. So what I mean to say is that employment, more people are getting employed. Point number one. Point number two, your wage rates are still rising. Point number three, the consumption doesn't look going down. So on all the parameters, US doesn't look like going into recession at this period of time. So other way of looking at it, if you can look at IT companies' results which have started coming in, okay, we have already seen they are maintaining their margins. Point number one. Point number two, why it's happening is because there is nothing wrong at this period of time in US. Yes, the rationale of rate going up and they going into recession is one thing which will happen on the later stage, but not as of now. There is a lot of time before anything goes wrong, so you still have employment coming over there. Coming to the second part of the question, where rupee will have a negative impact or positive impact. So, so whenever your rupee depreciate, that means I'm getting cheaper for at least US at this period of time, right? So there is going to be a plus for export companies. That is one way of looking at it. The other way of looking at it is because we are a crude importing nation, it's going to hurt us. It's going to be positive for us when commodity prices they start coming down. That means if crude comes down half of the price, you will see India at a major advantage. So that's the other thing what we are looking at. So its current situation it is negative. Yes, going forward for manufacturing, what India is looking at, it's positive.
Mm-hmm. So next question is, can NRI invest in PMS?
Yes. So this our PMS for NRIs, it's open.
Okay, we have a couple of more questions. Like, is there any lock-in period in PMS?
No, there is no lock-in period in our PMS. So I know where this is coming from. There has been a lot of PMS on the unlisted space. Sorry, AIF on the unlisted space on a category one, category two, where people have got stuck and they're not able to exit. And there are few AIFs on the category three also where people have invested with the lock-in, not knowing the impact what's going to create. We don't have any lock-in in PMS. Client can exit anytime if they want to exit.
Okay. Uh, I think we can take up other questions as well. We have time. Yes, sir.
Yeah, we can. Sure.
Next question is, do we invest only in listed companies stock in PMS? I have heard that we have other options like unlisted companies, real estate, gold as well in our portfolio in PMS. Am I correct?
Yeah, so our PMS is a long only PMS where I will not invest in any of the companies which or any other instrument. It is just the listed space which I want to invest. There are other PMSs which do invest. So our side of investing is only a long only side. That too, what I have explained. So that's how we do.
Okay.
No
And
unlisted
question,
space.
who are considered as ideal PMS investors?
So it's a tricky question. So anybody see the difference between mutual fund and PMS is you go to a PMS uh, buyer. The reason is because he has expertise of investing. Point number one. Point number two, he doesn't have restriction the way you have it in mutual fund, where the cash restrictions are there, and you have a restriction of increasing or getting the stake to a particular company at a particular level. Okay, so I'm talking about weightage over here. So our style of investing is very clear that we will invest into companies in the leader which is there in the sector. Okay, point number one. So I don't have uh, a determination, or I don't have a pressure of going into a value from a growth. Okay, so because we know where we are investing, so we are very clear of. I don't want to diversify this to a 50 odd stock, because when you diversify to a 50 odd stock, it turns out to be something else. What we have seen in the last 2 years, the reason for this upside was, so what was the reason for markets to come down in 2020 was COVID. So in spite of COVID, markets went up. The reason why markets went up was liquidity, because you were printing money. The Western world started printing money. So what is so I told that I am going to take this portion of what is the difference between 2008 and 2022. So this is my answer. The answer is 2008 was a problem where you were printing money. Point number one, because you had a problem of financial problem. So the second thing, you were facing a problem of demand, so demand was going down. Okay, third thing, your interest rates were going down. So what is the current situation? Are you printing money? Point number one. So you're not printing money at this period of time. You already printed money. Point number two, are you reducing rate at this period of time? What you were doing in 2008? No, you are not reducing rates. Point number three, were you trying to make sure that the demand comes up? You are trying to make sure that the demand goes down, so that the supply side could be matched. So you are on a completely opposite direction of what you were there in 2008. So the idea behind telling is, when you have different situations at different time, okay, so you are not worried about, in our style of investing, I'm not worried about whether I will be investing into companies which will have these problems, because I'll have no problem in terms of the two part of it, with the interest cost. Other thing is on the demand side. I'm already into an economy which is on a higher demand side, so that's one portion where I've invested. The other thing is, my companies are not going to get impacted by the interest cost. So that's how I differentiate myself with it. I hope I've answered your question.
Mr. Chok, I think I didn't get this answer. I think the question is from the investor side. Like, who are the people who are idle investor of PMS? If
People, yeah. So people who don't want to get into a diversified portfolio, where you want to invest into 50, 60 stocks, okay, and you are okay with a nifty return. So if you look at mutual fund returns in the last, let's say if I minus these 2 years, mutual fund returns have been lower than 10, or nifty returns have been also close to 8, 8.5. So PMS helps you get that extra alpha generation on your portfolio. So people who are looking for a portfolio which doesn't have higher number of stocks, a lower number of stocks, and with a specific style of investing. So when I say specific style of investing is, either you go for a growth style of investing, either you go for a value, or you go for a defensive style. So a mix of all the three. So PMS helps you get into that. So you, with us, you are getting into a growth style of investing.
okay, thank you, thank you. Now I think last question, one last question.
Yeah.
Sir, what's your outlook for IT sector in the long term?
Uh, so Mr. Manoj has this. So see what we saw in 2008, that was a time where we saw IT companies were enjoying margin above 30%. What happened for the next 10 years is, we saw them, the margins getting reduced. So few companies were at 35%, which got reduced to, I'll give you a range of 20% to 25%. So we feel that margin pressures are going to be there not now, but in coming quarters, you will see some margin pressures happening over there. But the good part is the book size at this period of time is good, okay, and we believe that they will continue to grow, but the pace could go a little low. Okay, that's our outlook for at least for short term. So we are closely watching if margin pressure continues to grow. Okay, then we'll take a call. So for a shorter term, we still believe that the margins are going to be intact. Okay, so that's our view on IT at this period of time.
Yeah, thank you so much, Mr. Chok. I think we have addressed all the queries from our participants. So thanks a lot. Thanks for accepting our request.
Thank you.
So, friends, I hope that Mr. Chuk has clarified the doubts of all of you regarding, PMS or investment opportunities in the current scenario. If any one of you have other questions, you can always connect with me or DS Agarwal, and we can sit together and discuss in detail.
I
So,
think there is one hand which was raised by Prachi Sneha. You want to take that question last, so I'm okay with
okay,
that.
Prachi, do you want to ask more question?
I think it's okay.
It's okay, okay.
No, take
Okay.
it.
Okay.
So, yeah.
Yeah, so friends, I would suggest that don't overdo the thinking process and make your decision to invest in PMS. Be wise in choosing your investment plan. Talk to your fund manager, that is Taxpoint, and let's resolve your queries. So, at the last, I would like to thank each one of you again for taking out time. We'll be uploading, I think we'll be uploading this recorded session on our YouTube channel by the name of Taxpoint Group. You can share it with your friends and colleagues. That's all.